Hi everyone! Inflation. It's a word that you hear a lot these days. If you're living in a country experiencing high inflation like Argentina, you're probably feeling it in your daily life. Groceries cost more, rent goes up, and suddenly your paycheck doesn't seem to stretch as far. Today, we're talking about how you can protect your assets and your purchasing power in times of high inflation, even when things get really challenging. And don't worry, we'll keep it simple. Step 1. Keep cash to a minimum. Cash is vulnerable in high inflation situations because it loses its purchasing power quickly. Think about it. If a loaf of bread costs $2 today and inflation is at 10%, next year that same loaf of bread will cost $2.20. Your $2 won't get you as much. Now, I'm not saying to stuff all your money under a mattress. It's good to have a small amount of cash for everyday expenses like groceries, gas, or unexpected bills. This is your emergency fund, and it's essential to have. But when we talk about keeping cash to a minimum, we're talking about anything beyond that emergency fund. Ask yourself, do you have thousands sitting in a checking account earning close to zero interest? That's the kind of cash that loses value fast during high inflation. Instead of letting your money sit idle, you can put it to work for you. That's where investing comes in. Investing is about putting your money into assets that have the potential to grow in value over time, outpacing inflation. Of course, every investment carries some degree of risk and there are no guarantees. But historically, investing has been one of the most effective ways to build wealth over the long term and stay ahead of inflation. In the next chapters, we'll dive deeper into specific investment options that can help you protect your money during high inflation. Now, what about your savings? Instead of holding cash, try to invest in assets that tend to keep their value when inflation is high. These are often called inflation hedges. One of the most common inflation hedges is real estate. As prices increase, the value of your property generally goes up too. Plus, you can often increase rent to keep pace with inflation. Another good option is stocks. Now, I know what you might be thinking. Stocks? Aren't they risky? And yes, there's always a risk with stocks. But over the long term, the stock market has historically trended upwards, even with periods of inflation. Why? Because companies can often increase their prices during inflation, which can lead to higher profits. Plus, owning stocks gives you a piece of those companies and their potential for growth. Then there are commodities like gold. Gold has been a store of value for centuries. When the value of paper money goes down, gold often holds its value or even goes up. Remember, investing involves risk. It's important to do your research and understand the potential ups and downs before putting your money into any asset. If you're in a country with high inflation, one strategy is to hold foreign currencies, like US dollars. When your local currency loses value, foreign currency can help you maintain purchasing power. Think of it this way. Let's say you live in a country where the local currency is rapidly losing value. You could exchange some of your local currency for US dollars. If inflation continues, your US dollars will be worth more in terms of your local currency, even if the US dollar itself is experiencing some inflation. Now, holding foreign currency isn't a perfect solution. Exchange rates fluctuate, and there are transaction costs involved in buying and selling currencies. Some people also look at cryptocurrencies as an option, especially for smaller amounts. Bitcoin, for example, is designed to have a limited supply, which, in theory, should make it resistant to inflation. However, I have to be honest, cryptocurrencies are very volatile. Their prices can swing wildly up and down in a short period, making them a high-risk investment. Whether you're considering foreign currencies or cryptocurrencies, it's crucial to remember that diversification is key. Chapter 4. Build a portfolio. Let's talk about building a portfolio. You don't want to rely on one single type of investment. This is like putting all your eggs in one basket. If that basket falls, you lose everything. Mixing different types of assets can reduce risk and help your overall wealth stay stable. This is called diversification. A balanced portfolio might include stocks, some real estate, maybe some foreign currency, and even a small portion in precious metals. The idea is that if one asset drops in value, another may increase, giving you more stability overall. For example, let's imagine a scenario where the stock market takes a dip. Your stock investments might lose some value temporarily. However, if you also own real estate, and the real estate market is doing well, the increase in your property value could help offset the stock market losses. The key is to find a balance that aligns with your risk tolerance financial goals, and time horizon. If you're younger and have a longer time horizon, you might be comfortable taking on more risk with investments that have higher potential returns. But if you're closer to retirement, you might prefer a more conservative approach. Remember, building a diversified portfolio isn't about trying to time the market or predict which asset will perform best. It's about spreading your risk and giving yourself the best chance of achieving your financial goals over the long term. Chapter 5. Consider bonds with caution. Some people ask about bonds. Typically, bonds are considered relatively safe investments, especially compared to stocks. When you buy a bond, you're essentially loaning money to a government or a company. In return, they promise to pay you back the principal amount plus interest over a set period. However, during high inflation, traditional bonds can lose value. Here's why. When inflation rises, interest rates tend to rise as well. Newly issued bonds will offer higher interest rates to attract investors. If you hold older bonds with lower interest rates, they become less attractive compared to the newer bonds with higher yields. As a result, the value of your older bonds may decrease. That being said, there are some inflation-protected bonds, also known as TIPS, or Treasury inflation-protected securities, that adjust with inflation. The principal value of these bonds is adjusted based on the Consumer Price Index, a measure of inflation. When inflation rises, the principal value of TIPS increases, and when inflation falls, the principal value adjusts downward. The interest payments on TIPS are also calculated based on the adjusted principal value. So, while traditional bonds might not be the best option during high inflation, TIPS can provide some protection against the erosive effects of rising prices. Chapter 6. Invest in yourself. Lastly, remember that one of the best investments you can make is in yourself. Developing skills, education, and knowledge can lead to higher earning potential, which helps you keep up with rising costs. Think about it. When you have valuable skills and knowledge, you become more competitive in the job market. You're more likely to get hired, earn promotions, and increase your income over time. This doesn't necessarily mean getting another degree. It could be learning a new trade, taking online courses to enhance your existing skills, attending industry conferences, or even just reading books and articles to stay informed about your field. Investing in yourself is about continuously improving your earning potential. The more you earn, the better equipped you are to handle rising costs and maintain your standard of living, even during periods of high inflation. Plus, the knowledge and skills you gain are assets that no one can take away from you. They stay with you throughout your career and can open up new opportunities for growth and advancement. To wrap up, inflation is challenging, but there are ways to protect your wealth. Focus on investing in assets that can hold or increase their value, keep cash to a minimum, diversify, and always be learning. Remember, there's no one-size-fits-all solution. The best approach for you depends on your individual circumstances, risk tolerance, and financial goals. When you're prepared, you'll feel more confident to face whatever the economy throws at you. Thanks for watching, and don't forget to like and subscribe for more financial tips.